Hello.
How are you?
I'm okay.
Yeah?
Doing good.
I was happy to see you come back to work this week.
How was
You had
that?
a pretty wild, didn't you have a kind of an interesting weekend?
I went to Las Vegas for the first time in 15 years. And that's about the appropriate amount of time in between Las Vegas trips for me. I'm here with all my brain cells, though. And I'll tell you one really cool thing that happened. I was walking through the casino and on the ground, I saw a white envelope. And so picked it up. And inside there was $420 cash and a bet for the Celtics game that was on Saturday night. The pot was $10,000.
You would have won $10,000?
And I think I could have cashed that ticket in. They're like, no name. There's an account number on it. So maybe in the end, the Celtics lost. But I finally came out of Vegas up. And it's because I found an envelope of cash on the ground.
Most people would not have come back to work for that next week after that.
$10,000? That could last me a week.
I'm talking about the average person.
I did think about taking my friends to Cabo for my birthday. If I thought, or maybe putting it all on black and doubling it.
See what I mean?
Who knows?
Of course, yeah.
Anyway, here we are.
Well, welcome to A Place of Possibility. We are happy to have you here. I am Richard Del Monte.
I'm Angela Wright.
And we have an interesting kind of a news flash to talk to you about today.
Yeah, so the debt ceiling is in the news again. And we've had some clients messaging us this morning, hey, should we be worried about this? So we thought we'd take a brief moment to chat about it. Interestingly, this morning, NPR News came out, what should you do as a consumer to protect yourself against the debt ceiling? And their advice was, pay down your credit cards in case interest rates go up and save your money. I mean, how about call your politicians and scream at them? Like, why is this on the consumer to deal with? I mean, it's just.
Yeah. No, we wouldn't do that. We're not going to touch them. Let's talk a little bit about the history of this whole debt.
Yeah, what is it and why are we dealing with this?
Why are we dealing with it and why is this such a big deal?
Yeah,
most people don't really understand. Other than they're frightened, but they don't know why.
Yeah. And you probably remember the day it was created during World War II.
Oh, yeah,
no, World War I. World War I.
World War I? Oh, it's even worse.
Just kidding. So it was created in World War I. Prior to that, Congress would just vote on spending issue by issue. And then the war happened and we needed tanks and boots and guns and clothes. And they said, oh my gosh, like we can't do this issue by issue. So they said, all right, let's just cap how much we can spend at a time. Go for it. And, we'll see what happens when we hit the wall. Well, they hit the wall like every year and they have to go and raise the debt ceiling. This is simply a formality. And what do you think? Like since the 1960s, how many times has the debt ceiling been increased?
Most people would have no idea.
They don't. Yeah.
Like they think 6 or 7.
Yeah. Right. It's the number is 78 times.
78 times.
And you heard about it probably 3 times.
Yeah. Right.
Right. So what's changed? In the last 2 decades, our politicians have figured out that they can basically hijack the debt ceiling for their own issues. And they're essentially playing chicken with our borrowing limit and saying, hey, I'm not going to approve that unless you get this little side bill in here for some town in Iowa, or, my issue, my party's issue. And it's becoming more of a partisan, game of chicken, essentially. But what they're doing is playing chicken with your Social Security payments, your bond interest and repayments, government workers, military salaries.
Interest rates overall in the economy.
Yes.
Right?
This game of chicken is wrong.
Yeah. Yeah. Plus, the interesting thing is we're one of only 2 countries in the entire world that even has a debt ceiling.
Yeah.
It's totally voluntary. We don't have to have this. The Congress could today vote to eliminate the debt ceiling and we'd never have this conversation again. But they won't. Why? Because they want to have something to fight about.
They can use this issue.
They can use it as a hammer.
But also, people hear the total debt. So we're at 31 trillion, I think, today. And they freak out because that's a huge number.
It's the most we've ever had, for sure, right?
Yeah.
It's terrifying to people.
It is. But let me change the perspective on this a little bit because it's actually not that scary. And so the real issue with our debt is the interest payments, right? That's like when it comes down to the wire, we got to make these payments. And when we think about the burden on society of the national debt, that's what we need to look at. And so if we look at the percentage of our total GDP, it's like all the output of our economy that we're giving away to this debt. In the 1990s, we paid 3.1% of our total GDP to service this debt. If you're watching this, you might be seeing a chart pop up on your screen. And it shows the total history of how this has gone since the debt ceiling started. So 3.1%, that's not that bad if you think about
And
it.
you know, you wouldn't be shocked by it.
No,
right?
not
Yeah,
at all.
Right.
Not
right.
at all. So this
But
morning,
it must be much higher now, right?
gotta be, right? We're at $31 trillion. So I
Yeah.
polled the staff this morning, like, hey guys, what do you think it is today? Percent of GDP. What do we get?
I mean, people thought 10 to 20% of our GDP because it's 31 trillion, right?
Yeah.
Right.
It is currently 1.8%
Get out.
of our GDP. And here are our congressmen screaming, we gotta stop this. Don't you know? I mean, hello. Like, why? Go ahead.
Because the economy grew a lot. The economy's been a juggernaut, and it's grown so big that the amount of debt is actually, and the paying the debt and supporting it and making the payments has become a much smaller piece of our overall pie.
Yeah. So when you put this into perspective, we're actually better off today than we were in the 90s.
But you're not going to hear that in the press.
I mean, I wouldn't watch that news.
We are going down. We're going down. The debt.
Right.
I mean, the debt. Let's clear it up. The debt is not a great thing.
Of course not.
You don't want to be maxed out on your debt. No one wants to have their credit card maxed out. But it's not life or death.
Right.
Anywhere. No one's going to get freaked out that we're paying 1.5% or whatever it is, 1.8.
Right. I mean, what would happen? Like,
service.
We hit the ceiling and our interest rates double, so our payments double.
Yeah. Then we're at 3.5 or something percent. It's still sustained. In fact, we've been higher before in the 90s.
We sure have.
So we have precedent. We're not in a terrible situation. I think people would be. People watch our podcast a lot because they like to get different perspectives on things, right? And they learn things. Well, this is something you could take with you and talk to your friends about. We're not at the end of our rope. We're not going down because of our debt. It's high. It's higher than it's ever been, but so is the size of our economy.
Right.
So
and so what is going to happen? Because there is a real impact on people who are currently invested in bonds, receiving Social Security, invested in stocks. We already know they're going to let this go to the wire. And if there's nothing the stock market hates more, it's uncertainty. So you can expect to see some volatility. But now is not the time to start trading around that volatility. I'll just get out until they fix this and then I'll get back in when it's over. Don't play that game. If you're already in a well-diversified portfolio, you are set up to withstand these, minor fluctuations. I hope they're minor. We'll see.
Right.
That we're going to have in the market.
Yeah. And I think, it's helpful to remember back in 2012 when we had at that time, they called it a fiscal cliff.
Oh, it's so dramatic.
The debt ceiling, but it was the same basic thing. And you may remember that they closed all the national parks. You couldn't go to Yellowstone. You couldn't go to these places because they didn't have any money. We survived it. The stock market did not like it. The market went down about 20% during that period of time. We got through it. Nobody even cares. It was a little blip in time. Nothing to overreact about. Can you imagine now thinking we overreact? I think the Dow is probably at 7,000 or something then, whatever.
Yeah.
It just wasn't, it wasn't a thing. It was at that time it was really scary, but it wasn't something you had to react to or prevent or get out of the market to get back in because you probably would end up getting back in at a higher price.
Yeah.
So just live with it. It'll be fine.
Yeah.
Relax. Part of the uncertainties about investing that you just can't get away from. Yep. Okay, so what are we talking about? What's our main focus of our show?
Our main topic today is sustainable investing.
Oh,
what the heck is it? Should we be doing it? Can we get a good return while helping others? Is this even a thing?
Yep. So to help us unpack this, I'm really thrilled. We're both thrilled to have Sam Adams here with us as our guest. He is of Vert Asset Management. And Sam, if you're there,
I'm going to read his bio. Let's tell everyone about who Sam is, because these credentials are fantastic. He's the CEO and founder of Vert Asset Management. He also chairs the investment research group. Sam leads the development of new products to help make sustainable investing easier for investors. He has been a featured speaker on sustainable investing at financial advisor conferences in the US, UK, Europe, and Australia. Sam is the author with Larry Swedroe of Your Essential Guide to Sustainable Investing. He sits on the education committee of the Forum for Sustainable and Responsible Investment and is a member of the Plan Sponsor Council of America's Investment Committee. Prior to launching Vert, Sam spent 20 years at Dimensional Fund Advisors, where he led the European advisor business and launched the Global Sustainability Core Fund. Sam has a BA in philosophy from the University of Colorado Boulder and an MBA in finance from the University of California, Davis. I consider him to be the king of ESG. Sam, thank you so much for joining us today.
It's great to have you, Sam. Thank
How
you.
are you?
Thank you for having me. It's great to be on. I was feeling quite relaxed today after you removing the debt ceiling concern from me. I'm even more relaxed. So thank you. Thank you.
Happy to help.
Yeah. Anytime we can help you out with that, you let us know.
I'd love to start with the main question.
Sure. Yeah. So, Sam, what is sustainable investing? For most people that don't know what it is.
Yeah, well, sustainable investing, the way we describe it, that's the catch-all term for all forms of responsible investing, and there's probably thousands of ways to do it. And so we break them down into three buckets: ESG, SRI, and impact. And I can describe what those are. But effectively, anytime someone is saying, "I want my money to do more good than harm," they're practicing some form of sustainable investing. The original form is SRI investing, or social responsible investing. It goes back thousands of years. A great example, one of my favorite examples, is the Quakers. They were trying to invest for total return like all the rest of us, but they said, you know what? We don't want to invest in companies that are profiting from slave labor. And so they excluded those from their portfolio. You might have people who want to exclude tobacco or alcohol or gambling stocks. You might have Catholics who want to exclude abortion providers or contraceptives. You might have people who want to include abortion providers and contraceptives, right? And so SRI is really taking your either deeply ethical or personal values or your religious values and putting them to work in your portfolio. And you're kind of balancing your own values with your economic values, right? So because some of those decisions might hurt your portfolio, but you're saying, you know what, I don't care how good tobacco stocks are going to do, I just don't want them in my portfolio, right?
Interesting.
So that's the original one. Like I said, it goes back a long ways. There's impact investing, which is kind of like a for-profit version of philanthropy. You're taking, a couple grand and you're sending it to some problem area to solve one specific need. Maybe, some village in Africa needs solar panels to power their irrigation system or something, or you want to help lend money to an inner city problem area. And you're not really concerned about the return so much. You really just want to solve that problem that you're passionate about. That's kind of a newer entrant, but the newest entrant is ESG investing, and that's environmental, social, and governance investing. And the best way to describe that is it's just like your normal conventional investment portfolio, but the fund managers or the investment manager is taking into account additional information. They're saying, okay, this company has great revenue, it's got great earnings, but are they relying on free water or really abundant natural resources to make that revenue? Are they creating a lot of pollution in that? Is that going to be a risk down the road? How are they treating their people? Are their customers happy? Are their employees happy? Do they have risk in their supply chain? Those are the social issues. And then how is the governance? How is the board and the management team working together to lower risk in the portfolio, in the company? So if you're looking at those ESG issues, they're really not about your personal values as much as they're looking at companies who are doing better for people and planet in their pursuit of profit. That last category is by far the biggest. I think 95+% of all money invested sustainably is in that ESG category. It's where the big institutional investors are practicing sustainable investing.
Got it. I think that's confusing to a lot of people because they'll come to us and they'll say, I don't want any, tobacco,
right,
but
or guns or whatever.
Yeah, but if you follow like party lines, let's say I don't want tobacco and guns, but I'm cool with abortion. And a lot of people don't know what's actually in the portfolio that they're investing in. Can you talk about some of the more common mistakes that investors make and then some of the antidotes to those mistakes?
Well, the most common mistake is the one that you're just talking about. And then it's tough to call it a mistake since nobody seems to be singing from the same hymn sheet here on what's ESG, what's SRI, and what's impact. Everyone's using the terms interchangeably. It's more normal to be confused about it than it is to actually have an understanding about it. And it's very common to see ESG strategies, a mutual fund or an ETF that's running as an ESG, that throws in a couple SRI issues, like let's just kick out the tobacco companies because most people are okay with that or want that, right? So they're very confused, and it's okay to do some blending there, but where it gets confusing is the following. With ESG, you can get market rates of return, very competitive, risk-adjusted returns, just like in your conventional investing. With some forms of SRI, if you start excluding a lot of, stocks or companies or industries that you don't like, you're going to have differences in returns, and they might not be beneficial to you. So you want to keep an eye on that. Another problem that comes up is, again, you guys were talking politics earlier. This has become a political football. There's some who argue that ESG is woke or progressive, and it's aligned with a certain set of values. And it really isn't. It's really just looking at companies and their risks and their opportunities. So if you blend SRI and ESG, you kind of get confused around that. And so I would agree with the politicians who say we don't want, any type of personal values or SRI dictating how we invest money, right? People should be able to do that on their own terms. And if we keep ESG and SRI separate, we won't run into those problems.
Interesting. You've talked about the triple bottom line before, and I'm just curious, what is it and what does it have to do with sustainable investing?
Well, I think for a long time, probably as far back as we can remember, companies just did this in general. They managed for profits, right? But they were looking after their people, and they were good stewards of the planet. And then somewhere around the 70s or 80s, I'm not exactly sure, people argue about this, we kind of became narrowly focused on just profits. And we said, we want to eke out as much, pennies per share earnings every quarter as we can. And businesses, a lot of businesses became singularly focused on profits. And it's a little bit narrow there. And so one way to describe the overall effort towards sustainability is to describe it as the triple bottom line approach, where we're looking for profits, but we're going to look after people and planet in that same effort. So it's people, planet, and profit is the triple bottom line.
So it's more holistic.
Yeah. And if you have a long-term perspective, if you're looking out more than, say, 5 years as your investment horizon, it makes sense that you don't want to really upset your employees or your customers, right? Or you want to have good risk management, right? So these
we
are
love upsetting ours, though.
They're all falling out of their chairs right now.
Go ahead. Sorry.
So it's good business practice. If you're thinking in the long term, sustainability comes naturally. Looking after people, planet, and profit comes naturally.
Do you have any examples of this at work right now, a company that's doing this well?
Yeah, there's so many examples. We kind of think of, and this, I'm going to pin this on my crew, the environmentalists. I'm an environmentalist at heart. But we kind of guilt shamed a lot of people over time, right? We said, stop flying, stop driving, stop eating red meat. You're the problem. You're the problem. So we kind of think of sustainability as a constraint. But a lot of companies have figured out how to make money and how to make better outcomes with sustainability. One of our favorite examples is the Empire State Building. This was a building that was 90 years old back in around the turn of the century. And they did an energy retrofit. They spent about $13 million. They started saving about 40% on their energy bill. So every year their utility bill was $4.5 million less. Right. So they paid back this investment in the energy retrofit in about 3 years. It was a more comfortable building. It was a more healthy building. It was using less energy. It was creating less emissions, and it was more profitable. They raised the rents. So that kind of process you'll see repeated in lots and lots of companies, but also personally. I'll use my mom as an example. She lives in Maine. It's very cold in Maine. She had an oil-based furnace. She bought one of these heat pumps. She put it in. She doesn't have to use oil anymore. She's using electricity. It's a lot cleaner for the grid. Her house is way more comfortable than it was with the oil-based furnace, and she's saving a ton of money. So again,
wow.
People, planet, profit ticks all the boxes, and this is kind of the direction sustainability is going in, is like, how can we do better with using less natural resources and making healthier and more positive outcomes for people? That's the whole push.
Yeah.
So going back to the profit piece, you mentioned that the ESG investing actually has returns that are comparable to, what are you going to call it, more traditional ways of investing.
Yeah.
But there's a common misnomer out there. Maybe it's a misnomer that ESG investing doesn't have the same return. So what do you
if I
say to
exclude
that?
Chevron, oh no.
Oh yeah, right.
Yeah. How does it compare? What's the reality?
How does it work?
Yeah, I think the longest chapter in the book is on the performance thing, right? This is people's most common question,
Sure.
right?
Yeah.
And there's a lot of academic studies on this, and it basically comes back down to that ESG versus SRI. With ESG, you're trying to construct portfolios in a similar way that you do conventionally, right? And then you tilt to companies that are doing better on sustainability versus not. And those companies tend to be a little bit more profitable. They tend to be a little bit less risky. And so it doesn't change your portfolio all that much. Now, if you said, I'm going to take out all the oil and gas stocks, and then we have a year like last year, of course, your portfolio is going to underperform a little bit because oil and gas, doubled in value last year, right? So you'll get difference in performances over time. But the longest running series we have for ESG goes back to about 2005. And those, 15, 20-year return series show that ESG and conventional investing are about the same, slight edge to ESG. So again, this is a way to invest that's not going to change your financial performance that much. Now, caveat, if you do SRI, you can get similar returns, but if you exclude a whole bunch of stuff, you're probably going to get different returns.
Okay, so you mentioned, use the word tilt the portfolio.
Yeah,
I think that's important because you're not excluding oil and gas, you're just tilting away from it. You're overemphasizing other more sustainable types of.
Well, if you ask 20 different fund companies how they deal with oil and gas, you're going to get 20 different answers. But from our perspective, a way to do this is to say, listen, there are companies, energy companies, oil and gas companies that are really leaning into the future, and they're trying to change their energy mix to more renewables, right? Because they know that that's the future.
Right.
And then there's other ones who are kind of dragging their heels, and they're like, no, let's try and slow this transition down as much as possible, right?
Yeah.
You see that in car companies. Some of them are leaning into electrification. Some of them are holding back. And what, one form of sustainable investing via ESG is, hey, let's lean into tilt more to those companies that are preparing for this future, who are kind of spending research and development dollars and innovating those new products that people are going to be using. And let's put less weight or take out the companies that are dragging their feet, right? And so as a sustainable investor, if you're doing that, you're saying, listen, I'm not changing everything that I'm doing with my investment portfolios, but I am kind of voting a little bit more for a sustainable future. And if those companies do better, I might do better as well.
Yeah. I think that's important for people to understand.
Yeah, it really is.
Right? It's a nuance, but it's important.
Yeah. I mean, I think, we've got some clients in the practice who really want to vote with their heart, and a standard ESG fund might not be the right thing for them because they really do want to exclude some of the oil and gas or other things. And then we have other people who say, this is a cool idea. I get it. Let's tilt a little bit. And those are the folks who want to, you see ESG in the fund name, that's your jam. If you're really in your heart of hearts, like, I refuse to invest in guns or something like that, you're going to want to dig a little bit deeper before you hit buy.
Right.
My analogy is food. Right. If you're switching to organic food, you don't really have to change that much, right? You could probably have the same menu items, same shopping list, probably even go to the same store, right? And then just when you're in front of the bread, buy the organic bread instead of the conventional. When you're in front of the, oh, wait a minute, this beef is 8 times more expensive than the conventional beef. Maybe I won't buy that today, or maybe I'll just buy the regular beef, right? And so you bring home your shopping basket, and was it 70% or 80% of it is organic? You can't do the whole thing, but you're getting a food, or in our case, a portfolio, right, with less nasties in it, probably similar nutritional outcomes. But you are sending a strong signal to that store and to the agricultural community that you want to see more sustainability, more organic foods. And if that's you, ESG is for you. If you're, I need grass-fed, macrobiotic, vegan, all those types of things, it's going to be harder for you to shop for food, right?
Yeah.
And if you're that way around your investments, it's going to be harder to put a portfolio together. You can do it, right? But it's just going to be a little more difficult, and you might have different outcomes.
I'm holding out for organic ding dongs, just for the record.
What, Annie's hasn't made those yet? Are you sure?
I think I have.
Oh, do you?
This is one of my favorite.
All right, I love it.
Right.
So
it says organic 3 times on the front cover. Let's do organic.
Wow.
Right?
In case you're not clear on the concept,
it's all down here too. But it's sugar cones. Like it's there's your ding dong.
Sugar bomb.
it's sustainably grown sugar, though.
So I love to touch on climate risk a little bit, because I hear people saying like, oh, ESG investing is the solution to climate risk. And then you have other people saying that's not even a real thing. Like, should investors be concerned about climate risk and the impact to their portfolio? And if so, what do we do?
Yeah, I think investors as a whole should be worried about climate. Just this is where conventional investing and ESG investing are colliding, because it's pretty obvious that we're having more frequent and more intense storms. There are parts of the world that are exposed to sea level rise and wildfire risks, and those are things that not just sustainable investors care about, right? If you're a conventional investor, even if you're a climate change denier, you want to make sure that your portfolio is prepared against those things, right? And so it's a big part of the effort to get more data and more information into the markets around climate risk. We invest in real estate. We have a real estate portfolio, and so this is top of mind for us. When the storm comes, we can move ourselves. We can often move our businesses, but you can't move the building, right? So you got to make the building resilient. You got to protect the buildings, and so these are things that the world is working on to develop more solutions for and more information and data on. When I say I want investors to worry about climate risk, I don't want you to be freaked out, right? These climate risks are for the most part slow moving, and the market is pricing most of them in. But it's not a foolish maneuver to lean into ESG if you're concerned about climate risk. If you really want to think about where climate risk is going to affect your life, think about where you're going to retire. If you're planning on going to Arizona to play golf, maybe it's
no water,
or not enough water to feed the golf course, or maybe it's too hot. Too many days, you're only.
I'm thinking Costa Rica. Will I be underwater unless I'm on top of
Arenal? Right.
Yeah.
If you're going there to golf 3 months of the year, and it turns out you can only golf 1 month a year, well, maybe you got to change your plans a little bit, right? So those are the types of things you want to be thinking about really long term.
So I think it's also important, again, for people that are thinking about this, and it's not about avoiding companies that are, completely avoiding companies who contribute to climate change. It's really about protecting the companies you own from their business being beat up by climate change, right? So there's, it's a different kind of, who wouldn't want to have that? It's like, just run the company without insurance, no problem. It doesn't make sense, right? It's just not.
Well, yeah, and so listen, we're going to need oil and gas for a long time still, right? And buildings use 40% of the world's energy and create 33% of the world's greenhouse gas emissions, but we're not going to stop using buildings, right? So the point is let's find companies that are paying attention to these issues and creating solutions for these. And the good news is that more and more companies are doing this. This ESG movement is really broad-based. It's not narrow. 10 of the 15 largest pension funds in the world integrate ESG, right? Over 50% of the world's central banks, the big boys, use ESG in the management of their portfolios. So they're using it to tune into risks more accurately than they could with just using traditional information. And so it's kind of here to stay, and it's just going to continue to grow. An analogy that I use with financial advisors is, 20, 30 years ago, we didn't really call it factor investing, or, we didn't really pay attention. We just said, oh, I want small caps, I want value stocks. Right. But it became part of our language because now we describe all portfolios in those kinds of ways. How much tilt do you have to this dimension or to that factor? We will look at portfolios in the future like this as well. How much climate risk are you taking? How much natural resources are you consuming? Are you exposed to more taxes as a result of that? It will be part of conventional investing as well.
So I think our audience is kind of probably, I'm guessing they're thinking, yeah, this makes sense. I could see this conceptually that this would make sense, but does it actually drive positive change in the marketplace? Is it working? Is it having the effect that people want it to have?
It does, but let's not say that we're saving the polar bears today. Okay, that's not. I moved my IRA money, and now the polar bears are going to be fine. That's not actually how it works. Despite what the ESG marketing brochures say, that's actually not what happens, right? Leave it to the financial services. You're going to get 5% alpha and save the polar bears. Sorry, folks.
Sounds like a deal. I'll have it.
So it depends on what you're doing, right? If you're investing in ESG, you're really just sending a signal and support for a change in traditional management of companies, right? You're saying, listen, somewhere around 15-20%, depending on who's counting, of all investment dollars around the world is invested in ESG now. Okay, so that's kind of and it's been growing rapidly. And so now companies are starting to look around and say, what part of my investors are demanding that I do this better? When I launch that next product, when I launch that new factory, are we going to use solar? Are we going to, think about how much water we use? And they're getting pressure from the investor community to do that. So when you join into an ESG portfolio, you're basically joining that growing cohort of investors who are what I call changing the ask. We want you to do that. We don't want you to pay so much attention to pennies per share next quarter. We want you to build value over the long term. And can you do that in a responsible way? That's what you're doing. That's a systemic change, right, that you're doing. It's kind of like voting. You're just kind of expressing your interest. That's very different from impact investing, where you're saying, I'm going to help this grocery store in this inner city food desert get off the ground by giving them $50,000. And that's 25% of the capital they need to run for 6 months. That's very different, right? So impact investing versus ESG investing is very different.
Yeah.
Okay.
So what advice would you give to someone who wants to start looking at sustainable investing but doesn't really know where to start?
Well, you got to read my book, right? I mean, that's like the most obvious.
Which is?
We have your Guide to Sustainable Investing here. I've read it. It's a fantastic book. I really do recommend it if you want to learn more about sustainable investing. We could send you a copy of it, or the website is there on your screen.
Yeah, we did run every chapter by my mom, and she's not a financial professional, so she.
Ask the mom test.
Yes, I do that. Everything I write for clients, my mom has read it first.
She's like, "What's an ETF again?" I'm like, "All right, let me take that word out." Yeah, so that's what we did.
Smart.
That's a great resource for you, but that's one of the things I say about sustainability in general. Don't be afraid of it, right? Because of the label or the connotations that you have.
It's greenwashing.
There's going to be, all kinds of criticisms from all corners, but try it out and you'll see that, it may fit you. Some things fit people, some things don't, I used to live up in the Bay Area, and I would commute by bicycle. I now live in Southern California, and you don't want to commute by bicycle down here. Right? So I'm not a less sustainable person. It's just that my new environment is not as conducive. So I do other things, right? So if you're interested in sustainable investing, the best thing to do is talk to your financial advisor, read my book, and just kind of start looking at it. And you realize that it's a very big part of the investment landscape now. And as I like to say, come on in, the water's warm.
Yeah, awesome. And Sam runs a global sustainable real estate fund. Did I say that? Yes. Right?
Yeah.
Tell us a little bit about how that fund would be different from a regular real estate fund. Like, what makes it sustainable?
Yeah, so a typical real estate fund might have, if it's an index fund, 400 or 500 stocks, all the public real estate companies in the world in it. We're investing in about the 150 most sustainable. So, the owner of the Empire State Building is, trying really hard to decarbonize and lower the emissions of all of their buildings. The Salesforce Tower is owned by Boston Properties in San Francisco. Same thing. That building uses 76% less water than a similar building its size. There's a lot of really neat things real estate companies can do to reduce their impact on the planet and make healthier buildings for people. We spend 90% of our time indoors. as a climber and a skier, that's kind of disturbing number for me. But I was like, kind of where the buildings we're in kind of have a huge impact on our health, right? So those things are important.
Sure.
So these 150 companies are the leaders who are really working on solutions for people and planet. Now you get similar returns and similar financial performance from this portfolio as you would from a broader based market portfolio. And so to me, it's kind of a no-brainer. You're like, well, if I wanted to tilt towards sustainability, here would be a way to do that without giving up much on the financial side, if anything. But I am pushing for more sustainability.
Yeah, I love
Wonderful.
it. Thank you.
Wonderful.
Yeah. Were there any questions that came in from the audience? No questions from the audience today. Okay. Thank you so much, Sam, for being here with us today, for unpacking sustainable investing, helping our listeners understand. I learned a ton from you today.
Them.
Yeah, the triple bottom line. I think that's so interesting.
It was really good.
So, okay, you want Sam's book, Your Guide to Sustainable Investing? There is a link that you can click on, or you can call us and we'll get you a copy. If you have any questions for us, please write to us at info@aplaceofpossibility. We'll also take topic ideas if there's something that you want us to talk about. If you'd like to make an appointment to discuss your financial situation, you can do that through our website or at the link on your screen. Be happy to chat with you.
So that's it for today, folks. Thanks very much for being with us. As always, we appreciate you and our entire audience. And as always, you're invested and so are we. We'll see you soon. Take care.
Bye.
Bye-bye.